All right, what's up, everybody? For today's video, we are going to be reviewing what's been causing all of the headwinds and bearishness in the market as of recently. We've got the dollar breaking out of a multi-year range here, and we're seeing things that we have seen before last year at the same exact period. Okay, this is a headline from January 7th, 2024, about stocks declining and Fed rate cuts being imperiled. And if we take a look, one of the biggest factors besides the dollar has been the pricing in of less and less rate cuts by the end of the year. Okay, we'll review this chart in more, but it's essentially just showing, fewer rate cuts. And that's been causing a large spike in treasury yields. Now, treasury yields have also been the headwind for the market as of lately. And we can see we broke through this 4.7 level on the 10-year treasury yield, which is a level that was, we were staying below this level for over a year. And we recently just filled this 4.77 gap up on the TNX on the 10-year treasury yield. You can see that's exactly where the 10-year treasury closed as of recently. And it's something that we've been watching and wondering if this was going to occur, hence the question marks. Now, rising treasury yields tend to be a headwind for the stock market. You can see here in this chart that they move inversely. As we saw a rise in yields, we saw a drop in the S&P 500, leaving us with the question of, is this sell-off over, and where are some potential buying opportunities if we are going to continue heading lower? So we'll review that in today's video. And the NAAIM number was also at 99%. We will review that each time that it's gone up to these levels. The market has stalled or seen a sell-off. But inversely, each time that we've dropped down to the current levels that we're at has been a pretty good buying opportunity. So we're going to review all of that and talk about why now could be a good time to start investing into the S&P 500, revisit that chart here to look at some potential areas of interest. And then we want to talk about the dollar. If the dollar starts to roll over, could that start to be a tailwind also for the stock market? I think it could, but more importantly, when it comes to yields and the dollar, how can we capitalize off of them peaking? And once they start to roll over, well, gold, I think, will be a really good opportunity. We'll break down the inverse relationship that gold has with treasury yields and the dollar in this chart and go over how gold still looks bullish, trading well above bullish price targets, and recently just bounced off of a bullish channel. I think gold could present a good opportunity if we keep monitoring the dollar and yields and start to see those roll over. It's very possible gold, specifically the GLD ETF, can come up towards 265 this year, if not higher. And going back to, market volatility in the stock market, this is January of last year. And we saw many, many declines of nearly 2%. And so far, we've had that same volatility in the beginning of January. The beginning of January right here was a, downwards trending period within the first week or so. And we're seeing the same thing again here, right? We're in a downward trending period, right? We're making lows and lower lows. So, these are all things that we've experienced before. The saying is, as January goes, so does the market. So we really want to see a positive return on the S&P 500 for January. We'll break down all of this in today's video. It's going to be a really great one. Be sure to read through the disclaimer, okay? And you can also sign up for my free newsletter, Investment Intelligence, using the link in the description below. I've sent out really amazing free trade ideas. I cover free, valuable finance and trading related content inside of there. And there's a website associated with it. So you can go back and review, see if it's something that you want, read a couple of the articles, and you can get those sent directly to your email inbox by signing up. Now, you can use promo code Powell to get a nice discount on the Investment Intelligence private trading group. That'll get you access to the Discord. Full access is what you want, okay? And if you get the full access, you get 20 plus swing trade ideas every week, custom scripts and indicators that I use for trading, exclusive intel, and exclusive chart layouts. So use the link in the description to sign up for those, and let's get into the video. And first off, remember the dollar, right? The dollar has been very, very range bound for a long time, since 2023. And here we are starting the year off with a massive rally in the dollar breaking out. This typically is a headwind for the stock market. It's not impossible, and it's not uncommon for the stock market and the dollar to rally at the same time. But generally, a weaker dollar provides a better environment for the stock market. So that has been a headwind and one of the main factors, perhaps causing some of this market volatility. But as I mentioned before, we're in a very similar place right now where last year, the market had priced in a bunch of rate cuts, and then, ended up finding out that we only got a couple, right? And look what the S&P just did in the year of 2024, an amazing return, 20 plus, 20% year in the S&P 500. But there was a lot of fear in January because, oh, well, we might not get as many rate cuts. But ultimately, that didn't hinder and stop the stock market from continuing higher. Okay, so currently what we're having right now is a lot of those same fears of us pricing in less and less rate cuts. Okay, so currently we're at the 425 to 450 basis point range. Okay. And now, if you take a look, the highest odds are at 375 to 400. So basically, two rate cuts is what the market is pricing in now for the end of the year. Or I'm sorry, only like one or two rate cuts. Okay. This is the current right here. And then this was over a month ago. So what I really wanted to show was that we went from 6% odds a month ago to 29% odds of no cut, of just staying here, right? So that's a big spike. That's a big jump in the increase. We went from 22% odds a month ago to only one rate cut. And we went from 32% odds down to 22% odds of two rate cuts. So the odds of us even getting two rate cuts have dropped lower, and the market's pricing in more now of us getting no cuts at all, or perhaps only a 25 basis point cut, like one or two cuts this year. All right. So that is basically where we're at right now. And things have changed a lot from just 1 month ago. Okay. So the big change in the numbers over here into the numbers over here is a big factor in essentially driving yields higher and the stock market lower. Okay. So that's what you want to understand. Now, you know, this doesn't have to mean the end of the world, okay? Just as we talked about, we were facing many similar situations in the beginning of the year last year, okay? Now, here's the yields. Here's the 10-year Treasury yield. Above 4.7 is not good for the market generally, okay? The market is freaking out about this, selling off because of these higher yields. The yields are ripping higher, due to the Fed rate cut probabilities, essentially higher for longer, right? Higher rates for longer periods of time. And so interest rates are following that. But if you go for what are some of the reasons, okay, we do have the negative reasons of, people think inflation is going to come back up, whether that's through, company policies or whether that's from, Trump and tariff fears, tariff inflationary fears. Those are things that we'll have to see if they actually come true, but that's what the market's pricing in right now. Okay. But also economic strength. The job number came in hot recently, meaning above expectations. It came in good, actually. All right. So the economy seems stronger than what, people were expecting. So the labor market is holding up and the labor market is seeming a little bit stronger. Typically, you see economic yields or treasury yields rise under good economic conditions, right? And the reason being, is because investors are going to want a higher yield to invest in bonds. Okay. Rates typically go lower, right, during times of economic uncertainty or fear. Okay, because you've got a lot of demand for bonds, and that's going to push prices lower. Oftentimes, the Fed can be cutting rates aggressively around these recessionary periods, also driving bond yields lower. So higher treasury yields doesn't have to mean the end of the world. It doesn't have to, be the thing that, sends the stock market into a bear market. But just the thought of the Fed even announcing rate hikes, all right, that could lead to a 2022 bear market situation where it wasn't so much recessionary. The bear market was really just caused by the Fed's rate hike cycle. Okay, so that's one of the biggest headwinds that we need to watch out for, or rather, signs of caution or a warning sign is going to be, hey, if the Fed gets into a point where they start making it seem like they're going to raise rates, or they actually do start raising rates, that could lead us to another bear market cycle, similar to the 2022 bear market cycle we saw, where it was caused by rate hikes. Okay. So we'll go ahead and move on from the TNX here, and let's talk about the S&P 500. We're approaching 5,800, which is a support level. Okay, was resistance over here, turned to support over here. It's a Fibonacci extension. 5,800 is going to be the first little area of interest. All right. we could drip down to there, and that could present a good buying opportunity. The next is going to be the 150-day simple moving average. You can see we bounced right off of here in the August lows of last year. So during the Japanese yen carry trade implosion, whenever that trade blew up, that we saw, a huge sell-off in the stock market, and we bounced right off of the 150-day moving average and continued higher. Currently, that's at 5,700. So we've got 5,800, 5,700 as two levels of interest. And we've also got 5,650. So I think if the market really wants to have another leg lower, we can get down to that 5,650 or 5,600 area. But it's very tough to time the market. And, we're already, the S&P 500 came up to right around 6,100. All right. So we're roughly 300 points off of the stock, off of the all-time highs already. If we come down to this 5,800, if you're a long-term investor, these are areas where you may want to start investing in the market and deploying more, capital out of your cash reserves for some long-term investments, okay? Or some trading opportunities or different things like that, right? So we've got 5,800, 5,700, 5,650 to that 5,600. Those are the three support levels here. If we break below 5,600, something must be going pretty wrong in the market, and we'll have to come up with a new summary and a new thesis, as to where the market is heading. But for now, I still remain a bull. The stock market selling off really hard on Friday on a good labor report seems like a buying opportunity to me, okay? Where, good news should be good news, all right? But sometimes the market reacts a little bit weird. Sometimes it feels like we're in the upside down where, hey, good news is causing the market to sell off. But I kind of just explained why those were selling off is because of the rise in yields and pricing in less rate cuts. Now, this is a really good visualization. We've got the 10-year Treasury yield up here on top. We've got the S&P 500 SPY ETF here on the bottom. And you can see as we've gotten this sharp rise in Treasury yields, bottoming right around December 9th, December 8th, you can see the stock market topped out right around December 8th, right around December 9th, and it has been in a downtrend ever since. The yields have gone in an uptrend. Okay, so this is just data backing up the things that I'm telling you, showing you that this is in fact why the stock market is selling off rather than just, making false claims. Now, another reason was we saw the NAAIM number. This is basically the number, how much portfolio managers are exposed to the stock market, okay? How much they're invested. And so once you get up to these 100% levels, 99% levels, which is where we currently were, or where we, not very long ago just were at those 99% levels, it means that portfolio managers were essentially 99% fully invested into the market, meaning they have essentially no cash on the sidelines. Oftentimes, that leads to times and periods where these, portfolio managers are overexposed to the market and they need to sell some positions to raise some cash, right? We can see here that, if you look afterwards, this is the S&P 500 on the bottom. Each time we've come up to these levels, we have sold off. All right, here we went sideways. Here we had a slight sell-off. Here we had a slight sell-off again. And here, once again, after hitting those 99% levels, we have started to see a decline in the stock market. All right, now, conversely, once you come around and you get below that 70% level, all right, typically this can be good buying opportunities. Now, it doesn't mean every time it comes to 70 that you have to buy. We can see it has gone much lower, but once you start to see this turn here as well, that typically marks a bottom in the stock market, okay? You can see the initial here, right? And then we start to turn and this starts to rise again and we see the S&P 500 follow, all right? And we've seen this multiple times here, except this period here where it hit 40, and that was just the beginning of the sell-off, and we saw an extended sell-off into October. So I really like this as a potential dip buying opportunity. As I mentioned, we're already almost 300 points off of the stock market. If you still believe we're in a bull market and that this isn't the beginning of a bear market cycle, there's no reason where you have to be extremely fearful of putting some money in here. 300 points off all-time highs in the S&P 500. If we're going to continue the year and have a bullish year, we should be well above that 6,100 price target, or those 6,100 level right now. Okay, so That's why we're coming back to this chart and coming up with potential dip buying opportunities. Okay, you don't have to go fully invest at each individual one. You can dollar cost average along the way. There's many methods. I'm not telling you guys how to invest your money, but really just my thought process around the situation and some of the key levels and areas of interest that I'm paying attention to here currently. All right. Now, the dollar, as we mentioned, is going to be one of the things you want to pay attention to. Okay. Now, there are signs of a sell-off and how to spot a sell-off in the dollar, and we currently don't have them. So, what are those signals and what should we be looking for? Well, you want to identify a key level, right? And I like to use the Fibonacci's. So here we have a key level and we're starting to form a top, right? We're no longer putting in resistance, or breaking through resistance. We put in a high, we put in a lower high. At this time here, we also see the RSI rolling over. Okay, so the relative strength index is showing us that we've peaked in relative strength and we're starting to decline in strength and showing weakness. That's a good sign. And we also got a bearish MACD crossover, all right? And this is on a daily time frame. We saw this same pattern arise here recently, okay? Right around that key resistance level, we formed a top around that level once again. We started to see the RSI start to roll over here, all right, and indicate that we're, seeming to be peaking in relative strength and getting weaker. And then we also had a bearish MACD crossover, but this didn't lead to an extended sell-off period. We continued to see strength in the dollar and we bounced off of our breakout trend line here, pushed up and just hit our next Fibonacci extension target, basically 109.50. So above 109.50, the dollar is going to be strong, and that's going to continue to possibly be a headwind for the stock market and for things like gold. Okay. But if we start to see this RSI roll over here, we start to put in a top around 109.50 and can start trading back below that level, and we get a bearish MACD crossover on the MACD. Those are going to be signs that, hey, maybe the dollar is going to start rolling over and come back down towards that 107.35 level. Okay. And if that does, we want to, ask ourselves the question, hey, how can I potentially, profit off of this? Okay. The stock market is one way, but the stock market doesn't always, just because the dollar starts to roll over, doesn't mean that the stock market necessarily has to do so. Which is why I like looking at gold as a potential opportunity, because if we start to see the yields roll over, we start to see the dollar roll over, that could be a very good sign for for gold, right? Look at the last time when we had 10-year treasury yield here in the middle and the US dollar in a sell-off, right? And we had gold in a nice uptrend, okay? Gold has been very bullish. And right now, we can see that we're in a period where we have a rising rates, a rising dollar, and that's been a headwind for gold. And we're seeing a decline in gold as we've seen a spike in both of these. Okay, so essentially what we're looking for is, if can we go from this period here, right, back to a period like this, where we start to see the dollar go down, we start to see 10-year treasury yield go down, and we start to see gold go back up. All right, so I think gold is very much worth your attention here in early 2024 as you continue to monitor those yields and the dollar. Gold is setting up for a nice trade if those two perhaps start to roll over. As we mentioned, the gold chart looks very good on GLD specifically, bouncing off of a nice bullish channel trend line here. And this could present to be a nice buying opportunity if gold can continue to maintain above these levels and hold this bullish channel even while yields and the dollar are still rising. Imagine if the yields and the dollar start to roll over and we're still trading in this bullish channel. I definitely think it's very possible for gold to get up here towards this 265.45 area early in the year, and potentially even go higher up to 280 or 300, depending on the extent of the magnitude of a rally in gold. Okay, now that's going to be it for today's video. Sign up for that newsletter. Okay, I sent out the very first exclusive debut of the Zone Finder, which is one of the custom scripts and indicators that charts supply and demand zones for you automatically, so you don't have to do the work. The very first trade idea from that I put out in the newsletter, and you can see the call options did very well on that trade with the nice setup of a falling wedge here, and obviously it ended up breaking out. You can sign up for that using the link in the description. All right, it's completely free investment intelligence newsletter, right? Or you can sign up for the investment intelligence private trading group. That'll get you access to the Discord. If you click on the full access and use promo code Powell, you guys will get 20 plus swing trade ideas every week, custom scripts and indicators, exclusive intel, and exclusive chart layouts. Just this weekend, I just updated the compression hunter. All right, I just updated the zone finder. I just updated the pulse radar. I just updated the strongest ETFs in the market on a relative basis. We went over a lot of things in there. Really good stuff. Also updated the equity scout. So there's so much inside of the Discord. I would love to have you guys in there. Thanks for watching. Smash that like button and subscribe to the channel for more.